Charlotte McLeod with investingnews.com, and here today with me is John Ciampaglia, CEO of Sprott Asset Management. Thank you so much for being here. Great to have you as always.
Yeah, good to be back.
Yes, it's been a little while since we last spoke, so there's a lot to cover, and we're going to hone in on uranium today. I wondered if you could start by taking a bit of a step back and helping me situate myself in where we are for the cycle right now. It seems that supply-demand fundamentals are always getting stronger. I know we have a gradual uptrend in the price, but investor interest seems maybe relatively low at this point. So how are you seeing it?
Yeah, it's interesting because we just passed the 1-year anniversary of the famous Liberation Day when Trump hit the world with all kinds of tariffs and tariff threats, and that was actually the low. That was actually the low part that we've seen in this cycle. It obviously hit a lot of commodities, and particularly uranium, because of all the uncertainty, because uranium is a very global supply chain. But if you fast forward from the lows when uranium was at $63 a year ago, we're now sitting around $85. So we've had a nice, healthy bounce. And I would say that for about the last 8-9 months, obviously things have changed dramatically in the last 6 weeks or so. But sentiment and interest in uranium has been incredibly strong. And I say that for a few reasons. One, the flows that we're experiencing into our suite of ETFs has been very healthy. And specifically for the Physical Uranium Trust, we have raised more money in the last 9 months in the Uranium Trust than at any point in its almost 5-year life. So we take that as a very strong validation that investors took advantage of the price dislocation last year and backed up the truck, so to speak, and added to their positions. This year, we started off very strong, a lot of positive sentiment, and obviously the last 6 weeks, investors are trying to figure out which way this whole conflict is going to go. And unfortunately, we've lost a little bit of momentum. And I would say there's no impairment to the long-term story. If anything, I think it's gotten better. But the short-term noise and uncertainty has really forced investors to the sidelines. Investors want to understand risks, and you cannot price or assign probabilities to risks in a war situation, and particularly with this administration. So what we're seeing at Sprott is a lot of investors are just sitting to the sidelines. They're not running for the exits, but they're sitting on the sidelines.
Yes, and I think that makes complete sense for investors right now. We'll get into a lot of the different points that you mentioned. Where I want to go first is with price. So I believe in the first quarter, we saw the spot price get briefly into the triple digit level. And I wondered if you could talk a little bit more about what was driving that, because I believe there's Sprott Trust activity that was playing into it.
Yeah, there was definitely a lot of excitement when we hit $100 again. And it was really being driven by a few things. Obviously, there's a broad, I think, bullish sentiment around nuclear energy, countries pivoting back to that technology and making a lot of investments around new builds. So that's always building up in the pipeline. But I think specifically, got a little bit of an added boost because we renewed our prospectus in the end of January. And there was a lot of, I think, excitement when we renewed the prospectus for $2 billion, which means the local regulator here in Canada has given us permission to raise additional units of the trust in value of $2 billion over the life of the prospectus, which is 25 months. And they also gave us the same annual purchase limit, which is 9 million pounds in the spot market, which they define as 365-day delivery window. And so I think what investors saw is finally renew the prospectus for a large number. We had a couple of very large institutional orders that came in on back-to-back days. The market got very excited. We got very busy buying uranium, and so far this year we've purchased just over 5 million pounds. So it definitely helped the price. There's definitely an element of price discovery here, and we had a lot of capital to put to work because when investors give us money, our job is to match the units of the trust with physical holdings of uranium. And that's what we did. So we were very active buyers in January and February. That definitely gave the market a boost. The war has obviously created a risk-off environment, and we've seen the price, retrench about $15. But the other point I should make, which is important, is the term price. And the term price is what they call a market reference price that's used to determine long-term purchase agreements of uranium. So uranium that will be delivered many years in the future. How do you price something today for something you may not receive for 3 or 4 or 5 years? So this term price is used as a reference price. And what we've seen with the reference price is it's gone up for 6 straight months. And it's right now sitting at $90. Now, $90 for historical perspective, it is the highest term price we've seen since 2018. So this is a very long, excuse me, I made a mistake. 2008. I got to go way back in time. 2008. So it's a very powerful signal that we're back to a price point, which was really, towards the tail end of the last market cycle. Now, $90 in today's world is not the same as $90 in terms of what you could buy in 2008. Cost inflation has obviously pushed that number up significantly. So when you think about what cost $90 in 2008, it can cost about $200 in today's inflation adjusted terms. So that's why we remain pretty bullish on uranium, that even though we're at 85 in the spot and 90 in the term, in the last market cycles, we were able to break $200.
That's some great context. I was getting excited about 2018, but 2008 even more significant. And I wanted to ask you about the utilities as well, the level of contracting that we're seeing. I haven't had a lot of uranium conversations so far this year, but when I was talking to people in 2025, it seemed like we were still waiting for them to come back in. My impression is that started to happen toward the end of last year, but where are we at right now?
Yeah, really good point. So last year was a very unusual year, mainly because of all the uncertainty related to tariffs and trade relations, and Trump, going to end the Ukraine war in a week that he claimed. And what happened was a lot of utilities just stepped away from the market for a good part of last year. We saw a very quiet market in the first half of the year. It started to pick up a little bit in the third quarter. And then it came to life in the last 2 months of 2025. It still was a below average year. And our expectation is that now, with a lot of this uncertainty lifted, we're going to get back to contracting. We are starting to see utilities come to market. I think the most notable that we should touch on is India. So India is, after China, has the most aggressive nuclear energy build-out plan in the world. And they just announced 2 multi-billion-dollar long-term uranium purchase contracts with the 2 leading producers in the world, which are Canadian-based Cameco and Kazakh-based Kazatomprom. So they are basically signaling that they want security of supply. They have not signed a big contract with Canada since 2015. So for them to come back in the market and sign these 2 big blockbuster deals tells you that they're getting very serious about making sure they have the fuel in place so that when they build all these new reactors, they're going to be able to turn them on. China has also been very active. South Korea has been active. And we're starting to hear rumblings. The U.S. utilities are starting to perk up in terms of the marketplace as well. So this year, we expect it to be better because, there's definitely was some pent up demand in the pipeline.
And would you say in these transactions, as more of the utilities are coming back to buy, is it the companies who still will have the upper hand in their negotiations?
Yeah, it's a really good question. So, years ago, like 5-6 years ago, it was very one-sided. The utilities had enormous negotiating power over the producers. And these are bilateral, obviously, contracts that get negotiated privately. And the utilities in the old days used to get very flexible terms, fixed prices sometimes, what they call flex options. So the utility could either increase or decrease their order by, say, 15% at the same terms at their choice. You fast forward now, key producers are not giving these flex options, and the prices they're going to be you're getting are going to be market reference, which means there is going to be an adjustment to the future price based on what the market is at that time. But more importantly, you're starting to hear about price ceilings that are around $150 a pound. So what does that mean? So if the price of uranium today is in the spot market is $85, so you can go and get it today at $85, but I don't need it today. I need it in 5 years from now. Well, the mechanism is you're going to pay me what the spot price is in the year of delivery in year 5, but we're going to create a floor, which is a minimum price, and a maximum price. Just so they call that a collar. We're going to collar the price at a high and a low. So right now, you may pay a minimum price of $75, but if the market's at $145 at the time, you're going to pay $145. If the price is $165 a pound, you're going to hit the cap and only pay $150. And that's a typical transaction that utilities will enter into for long-term delivery. So the fact that this ceiling price is now in the $150 range per pound and the spot price at $85, I think is a very strong signal that the direction of travel for the price of uranium, the market thinks it's going up.
That makes a lot of sense how you explain it. And I want to get a little bit deeper into the Iran war. I think a lot of people are wondering, what does this mean for the uranium market? And obviously, it's shown us once again how the oil and gas market can become quite precarious in times of conflict. So that would seem to be positive for uranium. But what nuance would you add there? Because I think there's a lot going on.
Yeah, I think it's a really good point. And we've been talking about this since February of 2022. And that is obviously when the war broke out in the Ukraine. And we felt at that time that particular event, and the related energy shock it created for Europe and Asia was really going to galvanize political will to shift energy policy back to nuclear energy. And remember, just 5 years ago, Europe was marching down a path of phasing out a lot of their nuclear energy and favoring either wind, solar, and natural gas. Well, natural gas has been disrupted. Obviously, there are real, physical limitations with trying to run an economy on wind and solar. And in the last month, it's amazing to us that, the president of the European Union, the chancellor of Germany, have both made public statements saying that their decisions to phase out nuclear energy in the last few years were strategic mistakes. And it only took 2 energy crises for, that to happen. But we think that the winners in the coming out of this from an energy mix perspective are going to be greater push towards nuclear energy because it's so energy dense. There's been no disruption at all to any of the uranium supply chains because of the war. The second winner is likely to be renewables, most likely solar, as people are looking to diversify away from oil and gas sources of electricity generation. And we're already starting to see, signs of that happening. Governments are starting to say they need to diversify away from their vulnerabilities to oil and gas. And the world's obviously learned how vulnerable, closing off one waterway, the outsized impact of that, obviously, on Europe and particularly in Asia, even Australia, New Zealand, countries that, we're scheduled to run out of gasoline in the next 30 days. It can really cripple economies. And so I think governments are going to take the lessons learned of the last 6 weeks and start to shift policy even further towards, mitigating against more disruptions.
You mentioned there haven't been disruptions because of the war for uranium. I did want to bring up what's going on with sulfuric acid because supply of that is being disrupted by closure of the Strait of Hormuz. We've had China say they're going to cut off exports. Can you talk about how sulfuric acid is used in the uranium sector and if there could be impact down the line?
Yeah, really great question. And people are probably wondering, what the heck does sulfuric acid have to do with uranium mining? So there's really 2 types of uranium mining. Hard rock mining, so think of it as, traditional mining, whether it's underground or open pit, where the uranium is hosted in hard rock, sandstone, granite, whatever. And then there's something called in situ recovery or ISR mining. Think of it almost like you're in the steppe or the desert. And the uranium is actually in the sandstone, and you have to physically leach it out of the sand. And one of the key reagents, as they call them, to do that, it's a chemical process where they inject sulfuric acid into the ground, and they basically leach the uranium out of the soil. It's more like oil and gas type of a process than actual hard rock mining. And Kazakhstan is the world's largest uranium miner. So think of it as the equivalent of OPEC. So they produce as much uranium as OPEC produces oil, about 40% of the world's uranium. And they exclusively rely on this ISR mining. Some mines in the United States also do this technique. And there's now concerns with disruptions in sulfuric acid and smelting and obviously oil and gas production, that countries are now saying, hey, we need to hoard what we have locally. We're not going to send our sulfuric acid elsewhere because there could be shortages. And so the questions are now, could this have a material impact on uranium mining? I think in the short term, the answer is no, because the wells get injected months and months and months ahead of when they're actually recovered. But if this conflict lasts for an extended period of time, depending on what where your source of supply is, it could definitely have an impact on uranium. It could also have an impact to a lesser degree on copper mining. Some copper mining processes require sulfuric acid, but the big thing that is being impacted right now are things like fertilizer. Not because somewhat about sulfuric acid, but also natural gas is a key part of the chemical process to produce fertilizer. And I think most people have no idea that all of these things are so interconnected. Thankfully, in North America, we're very energy and resource rich, but in a lot of places like Europe and Asia, I am sure they're having a lot of late night meetings panicking about what happens if we run out of gasoline or fertilizer or whatever.
Yeah, it seems like we're all on a crash course right now, learning how all these different things are interlinked. But so it really goes back to duration. And I'm finding that that's kind of what I'm hearing across a variety of sectors. We need to know how long is this going to last, which of course we can't know.
Exactly. And that's why it's so hard to manage your supply chain when you don't know if it's a 2-week thing or if it's a 2-year thing. And infrastructure takes a long time to build. I'm sure the wheels are spinning right now around, how do we change our infrastructure plan to mitigate some of these risks? We would expect countries will invest much more heavily in storage systems to store oil or gas or other key parts of their supply chain to make sure they don't get caught if there's another disruption.
Well, and on the note of supply, I wanted to ask you what developments you're watching most closely right now. I know in the first quarter here in Canada, there was excitement about Denison. What do you have your eye on right now? Because of course we do need that uranium supply.
Yeah, I think everyone was very excited and relieved to finally get those 2 permits in the Athabasca Basin, and we're talking about Denison and NextGen. I think these are the first uranium permits that have been given out in like 30 years. So this has been a long time coming, and the process obviously took years and years to get through. Now it's kind of go time. It's show me you can build these mines and get the product to market, and everybody's very anxious to see how these projects develop. Now, with all complicated infrastructure projects, we know there are time delays, there are snags, there are unforeseen things. And so companies are going to have to work through those inevitabilities and bring their product to market. I know utilities are very keen to diversify by supplier. So I'm sure they're having lots of very active discussions with those companies about signing agreements for their future production. We still have a few years away until, the material will hit the market. And it's very important because right around the time of those 2 projects are scheduled to come online, we see really big demand requirements in the market as some older mines start to run down, and obviously more and more reactors come online. So there's a real supply crunch building around 2030, 2031 and 2. And that's right around the time that some of these projects are supposed to be getting to production. So it's going to be very interesting to see if those two things intersect.
Yeah, I was going to ask you to bring everything together and tell me what the supply demand balance is looking like for this year, but it sounds like it's later on when we really get that crunch coming together.
Yeah, I mean, I think it's important to highlight we're in a deficit right now. I mean, it's expected that the world's uranium mines this year will produce about 160 million pounds. But uranium demand is at 190 million pounds, and every year it goes up by about 5 million more pounds because more and more reactors are getting life extensions. More reactors are turning back on after closing. A lot of plants are doing uprates, which means they're producing more electricity out of the same plant. All of these things require more uranium, which is why the demand curve keeps going up. And so there's been a supply response. Obviously, 5 years ago, the world only produced about 125 million, but all the easy stuff is done. All the restarts and whatnot. Now we got to get into the next phase of production, which is building brand new mines. And that's where the risks come into the timelines.
Well, as we're wrapping up, I'm wondering what your main message for investors might be right now, because as you've been outlining, it looks like the picture is just getting better, as it always seems to be for uranium. But we're also in this period right now where we have the war and maybe we're in a holding pattern. So what would your message be?
Yeah, well, I was just looking at some of the numbers. I mean, the uranium stocks is measured by the Sprott Uranium Miners ETF. They're up 17% this year, even though we've had this pullback. The S&P 500 is flat for the year. The uranium price is up about 5% this year. Obviously, it was up a lot more prior to the last few weeks. But I kind of joke with my colleagues that uranium has been kind of the sea of calm relative to other commodities that have been jumping around a lot. And I think it's because it has very different fundamentals that are driving its pricing. And we haven't really seen a pullback in interest. We've seen not just in our own funds, but all the funds that we track in this thematic, they've generally been bringing in money this year. So I think it's still pretty bullish. Now, in the short term, are we going to get wild days of, up 5%, down 5%? Absolutely. We're in that environment right now. Everything is susceptible to that. But I think if you have the right expectations, think about this as a 2, 3, 4 year, 5-year trade. I think it'll serve you well because the fundamentals look very favorable around that supply deficit, just getting bigger and bigger. And we just don't see any meaningful intervention happening in the market in terms of new supply coming online till at least 2030, 2031, perhaps. And I think that really supports the market. So volatile for sure. Don't get whipsawed around by trying to time it and trade it. I think you just have to dollar cost average and try to take advantage of some of these dips. But we view uranium and the broader critical materials suite of metals as being big beneficiaries right now. And unfortunately, the fracturing that we're experiencing in the world right now.
Well, I think that's a nice note to wrap it up on. And I like the context in terms of other commodities. It helps me visualize where we're at. So thank you so much for coming on to explain where we're at in uranium. This is very useful as always.
Yeah, thank you for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is John Ciampaglia of Sprott Asset Management.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.